Hello, and welcome to Wespath Retirement Webinar, The Road to Retirement. I'm Cheryl Hatcher, Senior Benefit Plan Specialist, and with me today is Frank O'Brien.
Good morning.
Senior Benefit Plans Educator. We are so happy to be able to present today regarding your road to retirement. A couple of things to start off with. We do want to let you know that this presentation is being recorded. And at the end of the week, I will be sending out the recording link as well as a PDF of the slides that we will be going through today. Second item is that there is a questions box. Now this question box is in your GoToWebinar toolbox. We do recommend that you go ahead and put questions out there if you have any during the presentation. We do have Todd Creviston, our other benefit educator, out there, be able to monitor the questions. But if there are any that don't get answered during this hour time frame, we will get back to you at the end by the end of the week. Okay? Third thing to show or to tell you about is that there is a handout section. The handouts there's 5 of them out there. A couple of them are the retirement checklist as well as the housing allowance worksheet. Please feel free to download those and so that you have them and print them off. They're all great information for you to go through and have for your reference and on your road to retirement. All right, so Frank, have I missed anything?
Nope, that's all the housekeeping we have for this morning.
Okay, wonderful. All right, so they say in the movies, on with the show. Today's agenda, we're going to be talking about the 2023 retirement process. What do you need to do? And how can we help you through that? Frank will be talking about the Wespath retirement plans and all of them that we have and that we have and how the distributions can actually affect your benefits. Frank will also be talking about the life stage retirement income as well as the life stage options to see if maybe the Social Security bridge could be an option for you. He'll also be talking about the housing allowance exclusion and how it is different in retirement and to be able to explain a little bit better how this is still just a wonderful benefit for you. And I'll go back through and talk about the participant resources and everything that's available to you. Okay, so that's a packed agenda, so let's get started. Let's talk about that 2023 retirement process. What do you need to do? We're going to talk about this as travel theme, so let's get packing. Let's talk about that retirement checklist. The retirement checklist is the first handout that is in the GoToWebinar handout section of the toolbox. This is actually a form that we developed based on your feedback. It is information to show when you should be doing certain tasks as of a certain time period. Myself, I like to be able to check things off or cross things off, so go ahead and print this off for your reference. Some things you might have already done already, such as notify your board of ministry, notified your cabinet as well as your bishop, but maybe some things that you haven't thought about, maybe such as making a call to EY Financial Planning Services. This is something that you can maybe do as well to think about your retirement options that you have at Wespath. Something else you can check about is verify all of your personal information, as well as verify your spouse's information, as the survivor benefits can be applicable to your spouse as well. Verify your clergy service record. Now, the information that's out there, if you note any discrepancies, feel free to follow up and contact your annual conference. Now, if you've gone through all of this information and verified all of this, you will be what we call an intends to retire, or ITR. If you go through retirement, account summary, you're going to see this happy, smiling man with the glasses. That's what you want to find, and that's what you want to click on to actually make your benefit elections. When you're actually going through, you can actually review your life stage investment management profile. Are you aggressive? Are you conservative or maybe moderate? You can change those if you'd like. You can also do a benefit projection. knowing that if you go through and do that now, it's not going to be the actual amount you get in retirement, but it's going to be a great forecast to let you know how much you can expect to have in retirement. So I've given you a lot of information regarding what you need to do and things you need to check off. But how do I do that? I hope you've been telling me through that, through your webinar, your screen, that go to Benefits Access. Yes, that's where you need to go. This is the area that you need to update and review all of this information that we just talked about. Two ways that you can actually go out there and do that. You can go through benefitsaccess.org, or you can actually go to wespath.org and click on the upper right-hand corner of Benefits Access. That's the way that I kind of like to go through it, because then I can review any information that I might have missed on the actual wespath.org website. All right, now we've been talking about the retirement benefits. So what about the retiree health benefits? Well, what you can do is you can actually check in with your annual conference regarding those retiree health benefits, as the different conferences might have different information to pass on to you. All right, now we're going to talk about Wespath retirement plans, and I'm going to give it over to Frank right now.
Thank you very much, Cheryl.
You're welcome.
So what we're going to speak about is the retirement plans. Before we get started on that, I just want to point out to you that if you want to begin to receive your benefits July 1st or early July of this coming year, you'll be making your benefit elections through Benefit Access. So Cheryl just reviewed with you how you can go to Benefit Access and review your information, and we highly recommend that you do that. You certainly want to understand your clergy service record, as benefits are going to be calculated based on that clergy service record, and your beneficiary designations. But once you've gone through all of that, and now it's time to begin to make your elections, you will do that through the Benefit Access portal. And you'll do that by clicking on the link with the man with the glasses who's smiling. And the running joke is he's smiling. Why is he smiling? Because he's going into retirement. Now, please note, if you want to receive those benefits in the month of July, that you need to make your benefit elections by 3 o'clock Central Time on Friday, June 30th, 2023. But please do not wait until that time frame to make your elections. We recommend June 15th, June 20th. Put something on your calendar so that it'll remind you to, one, go ahead and finalize your elections, or two, go back and review the ones you've already made that are pending for that night of June 30th, just to ensure you have everything in good working order. Now, through all of this, and you're going to hear about participant resources again later on, you do have the retirement team available to you to help you get through any questions that you have in terms of ensuring that your benefit elections have gone through correctly, the way you want them, and they are pending for that nighttime process of June 30th into July the 1st. Now, to kind of set the scale as to how the provisions for retirement work relative to the Book of Discipline, there are several different categories or provisions. The first is the normal retirement provision, age 65 or 40 years of service, or being the key word there. If you are age 62 and you have 40 years of service, then you are under the normal retirement provision. If you've only been in ministry for 15 years, but you're age 65 or older, you retire under the normal retirement of the Book of Discipline. There's also the early retirement provision, age 62 or 30 years of service. And again, the word "or" being key. If you're age 60 with 30 years of service, you can retire under the early retirement provision. But as we talk about the Clergy Retirement Security Program's defined benefit, we're going to revisit the early retirement provision and talk about some considerations around early retirement. There's a mandatory retirement age of age 72. And a 20-year retirement. So if someone's in ministry, age 55, and they decide to retire from ministry, they are able to do so. They go into the retirement appointment of 20-year retirement, and for their employer-provided retirement accounts, they wait until age 62, the early retirement provision, until they begin to elect to receive their elections, if that's what they so choose to do. So now we can talk about the income and where it will come from. This screen here shows you the different plans that we have. Some of you may have been in all of them, maybe just some of them. There's the Clergy Retirement Security Program. There's the Ministerial Pension Plan. And there's the Pre-82 Ministers Reserve Pension Fund. These are the employer-provided retirement plans, and I'm going to go walk through these plans. And then Cheryl will walk us through the UMPIP, United Methodist Personal Investment Plan. We'll begin with the CRSP. We love our acronyms in the pension world, so we have CRSP, UMPIP, etc. But we're going to talk about the Clergy Retirement Security Program. And in this plan is actually two different retirement arrangements set up. One is a defined benefit, a traditional pension plan. It's really the driver of the CRSP. You will elect and receive an annuity, lifetime income from the defined benefit. But there's also the Employer Supplemental Contribution Account, a defined contribution account, the DC. This is funded by the employer, a 2% required mandatory non-matching contribution, and hopefully all of you are participating in the UMPIP, and you receive an additional 1% contribution. So that's 3% going into that CRSP DC account. We'll continue on speaking about the defined benefit component. It's more involved. You're going to hear about the calculation as to how we derive the amount to annuitize. Later on, we'll talk about the annuities. We'll talk about the annual cost of living adjustment, or COLA, that you can attach to the annuity for it to increase that percent per year. But it's important for you to know that once you begin to receive that annuity, the decisions you made for that annuity are irrevocable. They cannot be changed after you begin to receive your annuity payments. Little sidebar, your account balances, you'll always have the flexibility of changing how, when, and how much income you want to derive. But the annuity elections you make will be irrevocable. It's not a balance, it's a formula. We first multiplied three factors together. So in essence, we're doing math. And the variables that are involved in the math include the denominational average compensation, DAC or DAC. We multiply that by the retirement factor, 1.25% or 1%, and we'll explain why that is. And then your credited service during that period of time. So again, just kind of echoing what Cheryl said about ensuring that your credited years of service record is correct. What is the DAC? Denominational average compensation. It's kind of what the words are telling us. We look at all full-time appointed clergy, we sum up their compensation, get the number of full-time appointed clergy, do the math, and come up with the amount. And we do it in advance. So for this year, we already know that it's $76,221, the DAC for this year. But we already know that for 2024, it's going to be $78,292, the denominational average compensation. And then we have the factor. For the time period of 2007 to 2013, the retirement factor is 1.25%. General Conference of 2012 reduced it to 1%, effective January 1st, 2014. So that's where you see that second bracket for June 3rd, up from June 1st to June 30th, 2023. And then your credited years of service. Assuming full-time appointed during this time frame, you have 7 years of credited service, 07 through 13. And then for 2014 to June 30th, 2023, for today's conversation, 9.5 years. So we have our variables. We've explained what they are. Now we're doing the math. The first thing you can see on this screen is the 76,221. That's the denominational average compensation. We multiply that by the 1.25%, 7 years, we come up with an amount, we annuitize that or divide by 12, and we get $556 per month. On the right-hand side, we have the second time frame. Now that's a 1% retirement factor, 9.5 years of credited service. We do the math, we divide by 12, and we come up with $603 per month. So we have the calculation of the two time periods done. And then we simply add them together. So you can see it adds up to $1,159 per month. But what will impact that? Decisions that you make relative to the choice of annuity and COLA percentage that you elect. If you're married, you're going to hear about surviving spouse annuity options. If you're single, you're going to hear about single life annuity options. We do provide an annual cost of living adjustment, or COLA. For the Clergy Retirement Security Program, it is a minimum of 2%. You'll elect a COLA. It could be 2, 3, 4, or 5%. That will impact the overall amount. And then if you have decided to retire under the early retirement provision of the Book of Discipline. And as I indicated earlier, there are some considerations to be made around that early retirement provision. Early retirement has a reduction in the amount of benefit that you're going to receive based upon the months or years of early retirement relative to the normal retirement age of age 65. So in an example we have up here in front of you now, we have somebody who is going to be retiring exactly 2 years as an early retirement, so age 63. They have 2 years to get to age 65. There is a 0.5%, a 0.5% reduction in the amount of annuity benefit that you will receive for each month of early retirement. So that works out to 6% per year. For in our example right here, this individual will have a 12% reduction. It's 2 years. That amount becomes $139, and we reduce the amount to $1,020 per month. Now, there's a couple of things to talk about here. First of all, it's not a penalty of any sort. You're getting paid for a longer period of time, and so actuarially speaking, you're still receiving your full benefit just over a longer period of time. But secondly, if your financial planning, retirement income planning is such that you don't necessarily need to receive this part of your benefit package right now, you can wait and defer to receive this annuity until you attain the normal retirement age of age 65 or 40 years of service if it happens at age 64, and receive the full amount of the annuity at that time. It's calculated as of 2023. We're not counting service anymore. The denominational average of compensation for 2023 gets used, but you can receive the full benefit. This is the first time we'll talk about utilizing EY financial planning services or your own financial advisor to determine whether or not you want to receive the benefit now or take the opportunity to defer that until a later time. But that's the early retirement provision. Now we can talk about the DC component of CRSP. As I said, this gets funded through employer contributions, 2% required, 1% UMPIP match. And what it is an account balance. And being an account balance, you can determine how you want this to be invested. You can direct your own investments, self-manage your investment allocation using the Wespath family of funds, or use Life Stage Investment Management, which is the tool that you ask us at Wespath to derive or actually to tailor your investment allocation using our funds for you. I'm going to get into a little more detail on that later on. It's a defined contribution account. It's an account balance. It is available as cash distributions. You can roll it over to UMPIP. We can't give advice and guidance, but here we recommend you do so because in UMPIP, that's where you maximize your flexibility relative to the options available to you to receive your account balances. You can also roll it over to another qualified retirement plan, but please note you want to take consideration of your housing allowance tax exclusion, because if you roll that over to a commercial vehicle like a Fidelity or a Vanguard type of vehicle, it's highly unlikely you'll be able to get your housing allowance from that distribution. But speak to your accountant, your financial advisor to ensure that. There is a required minimum distribution by age 73. If you don't want to take any of this out and you want to defer it and let it continue to grow, just know that the IRS steps in by law and says at age 73 you need to start to take distributions, generate a little tax activity. And then any remaining balance in your defined contribution account, your UMPIP account, you're going to hear about MPP 35%, that will go to your named designated beneficiaries. So again, preparing for retirement, go to Benefit Access, make sure your beneficiaries are in good working order, but look at other things you have in your household, retirement packages that your spouse may receive, life insurance policies, those types of things. Now we'll spend time talking about the ministerial pension plan. So the CRSP, you have the two pieces, the defined benefit, and then you have the defined contribution. With the ministerial pension plan, this was the employer-provided plan in place before the CRSP. And what is it? It is an account balance plan. 11% or 12% of your compensation went into an account in your name that was invested in the Wespath family of funds. Here, everybody in MPP is using life stage investment management, where we're tailoring the investment allocation to get you to, into, and through retirement with your account balances. And what does it become later in retirement? Well, I am glad you asked. 65% of that account, when you make your election to receive your benefit from MPP, 65% of that account will get you an annuity. You're going to purchase or buy an annuity. An annuity is simply a series of payments, in our world, a series of monthly payments that is provided to you for your lifetime. And if married, your lifetime and your spouse's lifetime. But there's that 35%. What happens with that 35%? That becomes an account balance. Here we recommend, again, rolling it into UMPIP. You have the account balance where you can determine how, when, and how much income you want to derive from that. So put together, there's your 100%. 65%, you have annuities. 35%, your account balance. You can see on the life annuity, there are 6 lifetime annuity choices. I'm going to review them with you now, as well as that COLA increase that you can elect to receive with that annuity. So all of the annuity types provide you lifetime income, you and your spouse, if you elect to receive a spousal benefit. Please note that once you and your spouse are both gone, there is no further benefit paid to anyone else from these annuities. Your account balances will always go to a named designated beneficiary if there's anything remaining, but once the annuity stream is complete, no further benefit to anyone. We have 3 life and survivorship annuity options available to you. And it applies to both the Ministerial Pension Plan and the Clergy Retirement Security Program. For the life and survivor options, you can see there are 3. There's life in 100, life in 85, life in 70%. So we'll look at the life in 70%. You go into retirement, you begin to receive the amount there, $1,166. Down the road, you pass away before your spouse. Your spouse would receive 70% of what you were receiving at that time. The COLA percentage you elect will stay with that annuity. But you can also see here in the payable to you column that the greater the amount of survivorship benefit that you elect, the lower the initial amount payable to you. But the higher amount, the contingent annuitant, survivor spouse, will receive in that annuity. So again, financial planning, retirement income planning, which of these options are better for you? And you can see that life in 100%, you both receive the same amount if one passes before the other. And then there are 3 single life annuity options. Here you have the life-only option. There's a life with a 5-year period certain and a 10-year certain annuity available to you. This is a single life annuity, a single individual. They just decide to get their single life annuity. You can see that this is the greater amount of all of the annuities we're going to review that you would receive. It's based on one single lifetime. Once that single individual passes away, no further benefit to anyone. But let's say someone who's single is going into retirement and there's someone in their life that's important to them that they're helping to support. Maybe a niece or nephew going through college, for example. The annuity can be set up with a 5-year period certain window where going into retirement, you're receiving your annuity. But there's a 5-year period certain window. And let's say something tragic happens to you in year 3. For the remaining 2 years, that named designated beneficiary will receive that benefit. And after 5 years, no further benefit. Or you elect to do that over a 10-year period of time. You go into retirement, you're moving along, 7 years into it, you pass away. For the remaining 3 years, someone would receive, your named designated beneficiary will receive that benefit. Then after 10 years, no further benefit to anyone. So you have the ability and the flexibility to just set up an annuity like that, just in case you want to have some background for somebody or some people that you want to help support. Just point out that if you yourself, you choose the 5-year window or the 10-year window, and you exceed those years in your own retirement, once you pass, no further benefit to anyone. So you have 6 annuity options available to you, life and survivorship with the survivorship percents. And then for the single individuals, you have some flexibility to support other people in your life while you're entering into your retirement years. And then we have the COLA. Does the COLA impact my initial benefit amount? Yes, it does. And here is how. First thing to point out to you is 0%. You can choose a 0% COLA, if you like, for your MPP annuity only. And you'll see as we illustrate this, it really becomes a fixed annuity over time. That 2% is required for the CRSP. That's the minimum there. But you can elect a 3%, 4%, or 5% COLA that you can attach to the annuity. This here will illustrate how the COLA impacts the amount you receive initially going into retirement and over the long haul through retirement. Don't spend a lot of time looking at the numbers on the left or the numbers on the bottom. This is for illustrative purposes only. But let's say an individual married takes a life and 70% annuity with a 2% annual cost of living adjustment. You can see they come out with, let's say, $1,700 in our example, and over time it goes up 2%, 2%, 2%, 2%. But through your planning, you determine you want to receive a 5% COLA. You get like the 5% COLA. Well, here you can see that the initial amount coming out to you is reduced. It's lower, but over time there's a crossover with that 2% COLA, and you get a greater amount of income later on in retirement relative to that 2% COLA due to the compounding impact of that higher COLA percent. So you can see here that the higher the COLA percent you elect, the lower the initial amount to you, the potential for more, well, you will receive more income in retirement later on through your retirement. As I indicated, you can choose a 0% for the MPP, and that becomes basically a fixed annuity over time. You can see that red line just stays straight. And then we also illustrate what the 3% or the 4% would do. Again, you can see relative to that purple line, the 2% COLA, the amount is reduced, but over time you begin to receive a larger amount of income relative to that 2% COLA. So working with EY Financial Planning, they can help you model these different COLA percentages to get a feel for what that may look like going into retirement and then through your retirement years. Coming back around to MPP, you can leave on account until age 73. It is an account balance. You can defer receiving it and let that get to age 73. Required minimum distributions kick in. Cheryl's going to share with you required minimum distributions. You have the annuity and the COLA options. And then just to point out to you, you have the 35% of an account balance and then that 65% for the annuity. You can actually defer receiving that 65% annuity and still elect to roll over that 35% into UMPIP to begin to derive income from that 35% and then elect to receive that annuity from that 65% later on. A lot of options and flexibility available to you with all of these different plans and programs that we have. You can roll it over to UMPIP. Again, we recommend you do that. You can roll it over to another retirement plan. The yellow flag of caution there is you want to make sure you understand what impact they may have to your housing allowance tax exclusion from your accounts. And there are other distribution options that you'll hear about when Cheryl reviews the UMPIP. And then lastly, for those of you who may be long tenured in your ministry and you have the pre-82 plan, in those days it was called the Minister's Reserve Pension Fund. Here with the pre-82 plan, we still have two things going on. The original plan, it's a formula benefit. It derives for you an annuity, single life annuity or a life and survivorship annuity. And there's a formula that's built into receiving that benefit. Years of service, again, clergy service record, years of service, pre-82, and what we call a past service rate. But also note that for many of you, a contribution was being put into an account in your name back in the day to fund that future benefit. And that is what we refer to as the defined benefit service money. It's really, the essence of it is an account balance, which has grown over time. So what we do is we look at the two different ways in which an annuity can be calculated. We look at the formula benefit, kind of the baseline pre-82 benefit. We look at your years of service. We look at a past service rate. The past service rate is determined by your annual conference. In our example here, 2.5 years times 600, we come up with an amount. We divide that by 12. It derives an amount for you of $125. But we have this account balance, this defined benefit service money, and let's say it's grown to $75,000. We run that through the annuity routine, and it comes out with an annual benefit of $2,500. That divided by 12 gives us $208.33. And what we do is we take the decision making away from you. We decide we are going to give you the greater of these two amounts. So going into retirement, that 208.33 in this example is what would be provided to you. But please note, each year we recalculate against the new past service rate developed or elected by your annual conference, and we do the math again. And if at any point that 125 becomes, let's say, $215, then we will switch out and give you that $215 as the annual benefit and no longer provide that 208.33. So we look at it each and every year and make that determination each year. If you're single, it becomes a single life annuity. There's no COLA attached to this. There's no period certain attached to this. If you're married, it's a life and survivorship annuity. The annual conference, your annual conference, determines the survivorship percentage, 70, 75, 85, 100%. So they make that determination. You can refer back to your annual conference for what that survivorship amount is. So that gets us through the employer-provided retirement plans, pre-82, MPP, current state of CRSP. And now, Cheryl, I'll provide this back to you to walk us through the UMPIP voluntary plan.
Thank you very much, Frank. A lot of great information regarding all of the Wespath plans. And yes, as we alluded to, we're going to talk about the UMPIP, UMPIP, or United Methodist Personal Investment Plan, the voluntary plan. I'm sure you're all aware of this, but what is UMPIP? So again, this is a defined contribution plan that accepts contributions from the plan sponsors as well as your employers. That's how some additional employer money could be in there. Maybe that was an option for you, so that was put in. But mainly what this has been for is for your contributions. You can actually put money in on a before tax or after tax or Roth basis based on payroll deductions from your employer. You actually have the choices of how it's being invested. Did you want that to be on a dollar amount or on a percentage of base amount? We actually do recommend the percentage base because then as your income goes up, then your retirement savings then also went up as well. You actually have that choice of whether you want to manage the accounts yourself or did you want us to manage it for you? So those are the options. Again, as Frank had mentioned, the defined contribution plans are account balances, so you have a lot more flexibility with these. So regarding your personal contributions, again, you could have put money in on before tax, after tax, or a Roth basis. How you put that money in is going to determine how it's taxed when you take it out of retirement. Okay, so those are your distributions in retirement. So on a before tax basis, then that money is going to be coming out to you as in taxed. You have to pay the tax man one or the other. So if it's before tax, you pay the tax on distribution. For Roth, I want to make sure that you're aware that if you qualified for the Roth, then you're putting money in on an after-tax basis. That bucket of money for the Roth amount, then that amount that you take out, again, if you're qualified, will come out on a tax-free basis, and any earnings on that tax bucket of money for the Roth will also be tax-free. Now, there's been IRS regulations as far as limits are concerned, as far as each year, how much maximum amount you could put in. If you've already exceeded those for the before tax and Roth and the employer portions, you could have put money in on an after-tax basis, and then that bucket of money, but any earnings on that bucket would be taxed, but any earnings or any amount taken out on an after-tax basis would be tax-free. Now, you don't need to keep track of what's in each bucket. Wespath keeps track of that for you, so you don't have to. So these are the limits for the 2023 contributions. Again, you have time to put in a more into your contribution, even though you're retiring as of July 1st. You can still max this out if you can and put that money in. Just need to contact your Human Resources Department to increase your contributions. Now let's talk about rollovers. Rollovers are near and dear to my heart because this is what I handle these at Wespath. So what are rollovers? And rollovers, in this example, it's not me trying to teach my dog a new trick. It's actually portable money that you have from another retirement plan that can actually be rolled over into your UMPIP plan. If you happen to have another IRS qualified plan or maybe even a traditional IRA, this amount can be rolled over into UMPIP. Now, it is a hopefully very simple process. You go ahead and complete an incoming rollover form. If you have any questions on this, you can contact me with any questions since I do handle them. I am the rollover specialist here. So you can you can actually do this either while you're active or even when you're retired to roll money over into UMPIP. And also, just another common question that we receive during our consultations is, can you roll over your spouse's money into your UMPIP account? And unfortunately, you can't, since they have to have their own account, and if they're not, don't have that relationship or don't have that account with us through the United Methodist Church, then it can't be rolled into your account. Okay, but definitely contact me if you have any questions on rollovers. Now, here's a great chart that we like to show. We're not going to go into detail on these. These are just all the different types of funds that we have here at Wespath. But this is showing the potential risk, or the risk and potential return are showing that they're generally correlated. So remember those stable value funds, capital preservation funds that we have, that's going to be your lower risk funds, but they also have a smaller rate of return on those. So that's going to be your stable value fund. And as you keep going up and up and up that scale, your the potential for most return is your international equity funds, but that also has the most risk. So, but this is a great way of showing all the funds that we have and on that risk versus return scale. Distribution options for you during retirement. Want to let you know that you do have options, lots of options. You can take the distribution as a full or partial lump sum. Of course, you want to talk with your tax advisor or maybe EY Financial Planning Services to see if that is a right option for you. And also note that it may have an impact on your housing allowance exclusion. But what a lot of our participants actually do is take cash installments. You can actually do that on a self-managed basis or using life stage retirement income. If you were to do that on a self-managed basis, you tell us how much you'd like to withdraw each month. For example, maybe you'd want $500 to come out for the next 4 months, but then maybe after that you want to drop it down to $300. You can do that. You just need to let our retirement team know what your wishes are. If you wanted to just have life stage retirement income actually calculate what would be the monthly amount to last your estimated lifetime, you can do that as well, and then have that amount paid out to you on a monthly basis. Remember that since, as Frank had mentioned, any account balance plans that we have, and UMPIP is one of them, any amount that is remaining in that account upon your passing will be paid or passed off to your beneficiaries. So again, another time to examine your beneficiaries that you have on file. We know that beneficiaries can move, so make sure that that information is updated accordingly. Again, Frank had touched on this a little bit, but the required minimum distributions. So as of December of 2022, the required minimum distribution was raised to age 73. Required minimum distribution is what we call an RMD. So again, you need to start this no later than April 1st of the following year after you turn 73. Now, if you do that after you turn 73, then remember that you will receive 2 actual distributions in that year, because subsequent RMDs each calendar year are using the prior December 31st balances. So you will receive 2 at that time. Now remember, this goes for all of your balances, all of your defined contribution accounts, as well as any of your defined benefit if you haven't taken them already at this time. So again, you can, even though you're retiring, you can leave your funds on account with us until age 73. Just letting you know that. Now we're going to switch it over to Frank, who's going to be talking back about the life stage services. Okay, there you go, Frank.
Thank you, Cheryl. Thank you very much. So we'll talk about life stage. We're going to talk about two programs, life stage investment management and then life stage retirement income. And we've mentioned life stage investment management along the way. Basically what life stage investment management does is you're asking us to tailor an investment allocation for you within the Wespath family of funds. The first thing that we do is we get some information about you. We look at your age, your expected benefit commencement date, any Social Security benefits, other Wespath benefits that you have, and then this notion of risk tolerance. As it relates to the investment markets and your degree of comfort with the investment markets, are you a conservative investor? Are you a moderate investor? Are you an aggressive investor relative to how much risk you want to take with your accounts? And you can let us know that, and you can change that through Benefit Access through the course of your time with us. We take that information, we tailor an investment allocation for you, and we put it on autopilot. But autopilot doesn't mean it just kind of stays where it is. The way the program works is we're doing two things over the course of time. I'll use an example of somebody who's 60 years old and they have a 60-40 investment allocation, 60 being in our equity funds and 40% being in our fixed income funds. So you're 60 years old. As we age up, the amount of the equity side, that 60% slowly and subtly comes down, the amount of the income slowly and subtly goes up. We need the risk in the portfolio to get the growth, but we need to have a more robust amount of fixed income over time because we're starting to pay retirement income benefits to you over time. So it's a glide path relative to your age at a particular point in time as to where we want you to be. And we do that throughout the course of your retirement. But the second thing that we do is we look at that investment allocation quarterly, 4 times based on your birthday. So quarterly off of your birthday, we'll look and say, hey, we want you at 60-40, but the markets change all the time and you went to 70-30. Well, we're going to shave off that 10%, get it back to 60, get that 30% back up to 40. Or it went in reverse. It went to 50-50. We're going to shave off that additional 10% of income, get it down to 40, and increase that amount back up to 60-40. And because we're actively managing it that way, history tells us that there's a chance for a higher internal rate of return from that portfolio of investment funds because we're managing it in that regard. So we're looking at it constantly and making sure you are where we want you to be while we do this long-term glide path. So it's a very powerful program with those two things working together. The second program is Life Stage Retirement Income. This program has been around for 10 or 12 years, but we added some new features to it last year. Life Stage Retirement Income, the first thing you can see in the middle of the screen is it works in tandem with Life Stage Investment Management. For this program to work, we're using both of those life stage services simultaneously. And again, we're looking at you. We're getting your age, your account balance, survivor's age, risk tolerance, things like that. And we have your account balance. And what we're doing with Life Stage Retirement Income is you're asking us to derive the amount of monthly installment payments from your account balances that we can derive for you. And the intention and the practice is for us to derive that monthly installment amount for you throughout your retirement with increases coming into that installment amount each year. Now, it is based on market activity, so you can have a down year in the market and not necessarily see an increase one year over the next. But over the long haul, I am allowed to say that there's a high probability of success. This will last through your retirement with those increases coming your way to help you with purchasing power. Then we introduce what we call the Social Security Bridge and the Longevity Income Protection Contract. I'm going to review each of these. Just to let you know, I talked about how annuity elections and COLA elections are irrevocable. Here with your account balances, if you go into Life Stage Retirement Income, you can come out. If you start to self-manage your installment payments and you want to use Life Stage Retirement Income, you can. The Social Security Bridge, and the Social Security Bridge and the Longevity Income Protection, they're optional. You can use one, both, or none, even if you are in life stage. So as many of you may know, and I'm sure you're all familiar with the fact that under Social Security, we have a full retirement age. But with that full retirement age, if we elect to defer receiving that Social Security benefit from our full retirement age to age 70, we get what amounts to an 8% increase in the amount of Social Security benefits you're going to receive. So my full retirement age is 67. So if I decide I'm going to take advantage of this bridge and wait until 70 to begin to receive my Social Security benefit, I'm going to get a 24% increase in that Social Security benefit. But I still need to derive income from my monthly income needs. So I'm going to use my account balances at Wespath to give me that income amount. So we have the base installment amount that we've calculated, and then I will tell through Benefit Access what I want my as-if Social Security amount to be, and that will be provided to you over time until you begin to elect and receive your actual Social Security benefit. Once we see that you're receiving, and you've told us you're receiving your Social Security benefit, we reduce the amount coming out of your account balances just to that base life stage retirement income installment amount. So we level off the amount and we bring down the amount coming out of your account balances. That helps us with the sustainability of your account balances to last through your retirement. When you indicate to us you want to take advantage of the bridge, we will reallocate your accounts through life stage and put an amount into the stable value fund where those as-if Social Security payments will come from. So we do capital preservation relative to the amount to fund your Social Security benefit. That last bullet there, we recommend all of you, many of you may already have, go to ssa.gov, set up a My Social Security account. It takes about 10 to 15 minutes to get through it. A lot of security because it's your Social Security account. You set that up, then you can start to run your own statements and understand what your Social Security benefit would be. You don't have to wait to age 70 to turn off the Social Security bridge. You can always do that at any time if you go into retirement with that bridge. The next is a longevity income protection contract. It's a deferred annuity. You purchase it through an outside insurer at retirement. So when you're on Benefit Access making your elections and you go through that section for life stage, you'll see an amount that's available to you to purchase this longevity income protection contract. It is a deferred fixed annuity contract that begins to pay to you when you attain age 80. So at age 80, you know you're going to get another stream, a steady stream of payments over your lifetime. If you're married, it's a life and 70% annuity. So later on, you know you're going to get another stream of guaranteed income with your Social Security, your CRISP DBs, your MPP 65% annuity. This provides flexibility to spend a little bit more in your early retirement years, knowing you have this fixed income coming later, which can provide some peace of mind for you. If you purchase this deferred annuity contract, it's deferred until you begin to receive it, and this amount does not get incorporated into any RMD calculations if you so choose to just use the RMD that's available to you. The annuity based on group insurance rates just means we're using this as a group insurance plan. It reduces the cost of the annuity contract for you. As far as actual receipt of your monthly income is concerned, the first business day of each month, you will receive your annuity payments. The second business day of each month, you'll receive your account balance payments. When you make your elections on Benefit Access, you will provide to us your banking information. Good news is you only have to do it once. We save it for all of your additional elections that you'll be making. But the thing to point out is, with July 1st always being the date, we have July 1st, we have the 4th of July holiday, and then we have weekends. So this year, July 1st is a Saturday. So then we have Monday as a business day, then we have Tuesday as the 4th of July. We take extra steps when we do this process in June to July to ensure everything is reconciled and the way we want it to be, the way you want it to be. So it takes a couple of days of additional review. And with those weekends, July 4th, your first payments will probably hit the end of the week around July 7th. But thereafter, first business day, your annuities, second business day, whatever you're receiving as installment payments from your account balances. We will be asking you to make your tax elections when you're making your benefit elections. If you decide that you don't want any taxes withheld, so 0%, you still need to tell us that. If you don't direct us to withhold 0% of your federal taxes, the default of 0% will result in a 20% tax withholding on any distributions that come out. They're partial distributions or any full distributions. If you don't tell us what you want, then we have to, by law, take 20%. Now, it means you're only going to get an 80% of what you might be expecting. The 20% works out at the end of the year when you're doing your tax filing, But again, you might expect to receive $100, you're only going to receive $80. For those who are using the RMDs or have to take RMDs, again, let us know what you want for tax withholding. If you don't, the default's going to be that 10%. Now we'll talk about the housing allowance exclusion, a great tax advantage for clergy participants. The way the housing allowance works in retirement is the IRS has us derive, or has you derive, 3 numbers as to what you can determine as eligible for the housing allowance exclusion. And it's the lowest or the least of the 3 numbers that you determine is what you can use that particular calendar year. The first number is, well, what did I get as retirement income from Wespath? You'll know that because in January of a given year, we're going to send you a 1099-R form that's going to look back at the year that just passed, and you'll know what we provided to you as income. The second is your actual housing expenses. You want that number to be as north as possible because it's the lowest or the least of the 3 numbers that you can use. So it's the big ticket numbers like mortgage, interest, or rent, renter's insurance, homeowner's insurance, property tax, your utilities, cable, wireless, all of that, as well as landscaping, snow removal. You go to the local Walmart, you get fantastic, keep the receipt, put it on your spreadsheet. That's eligible for the housing allowance exclusion. And then the third is if you own your residence, what's the fair rental value of that residence, fully furnished, plus utilities in the neighborhood that you live. So it's a market comparison that the IRS has you do. Here we recommend go to a realtor, get a comparison letter, they call it a comp letter, find out what you can rent your place for. Refresh that every year because rents do go up year over year. But now you have your 3 numbers. What'd you get from Wespath? What's your actual housing expenses? What's the fair rental value of your home? And it's the lowest or the least of those 3 numbers that comes right off the top of your monthly or your household income, and the rest goes into your tax filing season with other credits, exclusions, and deductions that are available to us through the code. Here's a simple example. You receive $24,000 from us. $20,000 is your actual housing expenses. You could rent your place for $21,000. The lowest, the least, is $20,000. Now that $4,000 is the amount taxable, but again, you don't know if it's all going to be taxable because of other exclusions, deductions, and credits that are available to you. It's available to retired clergy. It's not applicable to surviving spouse unless it is a clergy couple. So the clergy person passes away, the housing allowance goes away. That housing allowance exclusion worksheet that's attached to the webinar on the toolbar. The 4th paragraph there, we have a sentence or 2 that we recommend attaching to your 1040. Just in case somebody's looking at it, doesn't make sense, they can say, oh, housing allowance is involved here, and they'll move on with their review. And then refer to the section in your conference journal. What does that mean? You don't actually have to do anything relative to the declaration of eligibility for the housing allowance of your income. Your annual conference, at annual conference, in the annual journal, has language in it that says in the next calendar year, all of our retirees in this annual conference, their income they receive from Wespath is eligible for the housing allowance tax exclusion. Eligibility always has to be declared in advance of receipt of the actual monies. So that's done each year looking at the prior year on a rolling basis. So you don't have to do anything. We recommend this year you're going to retire, take a print off from the PDF you received of that annual journal, that page, put it in your folder, but after that, you're all set relative to the housing allowance exclusion. Lastly, we'll talk about the Comprehensive Protection Plan, the CPP, the death benefit in retirement. Here, as far as eligibility goes, the first thing is eligible to receive benefits under CRSP. And then, based on your clergy service record, have you been enrolled in CPP for 12 of the last 15 years? Or have you been an active participant in CPP for 25 years? Any of those, you're now eligible to receive the death benefit. How this works in retirement is you can see the provision is based on the individuals on the left-hand side, and a flat amount is provided on the right-hand side. So the retiree, the clergy person, passes away. The retiree spouse receives the amount of $20,808. If the retiree spouse passes before the retiree, then that retiree will receive $15,606. The retiree passes away, the surviving spouse got the benefit. Subsequently, the surviving spouse passes away. That individual's named designated beneficiaries will receive that flat amount of $10,404. And in the unfortunate circumstance where an eligible child passes away, then either the retiree or the surviving spouse would receive that flat amount of $8,323. This is a flat amount. It gets increased at General Conference. So General Conference of 2024, there'll be a resolution to increase that amount by either 2 or 3%. That's escaping me right now, but it will go up after the next General Conference. And now we're going to talk about participant resources and give this back to Cheryl to take us home around participant resources. And what I like to say is there is a plethora of resources available to you. Take advantage of all that you're going to hear, other resources that we have. Certainly, there's a lot of ability for you to work with us and us with you to make you clear and understanding and comfortable in the choices that you'll be making going into retirement. So, Cheryl?
Thank you, Frank, and I always love that word plethora. We have a plethora of resources available to you. Before we get into what those are, we want to do a little promo on our newest event that's coming up. All new clergy event that's coming up on May 17th at 1 o'clock Central. Go ahead and scan that QR code. You can get yourself registered. It's going to have information and insights regarding benefits, well-being, and investments. It's going to be in a very new, unique format, and we're very excited about it. So we encourage you to join up and see it for yourself. So talking about our first resource available to you, we've alluded to it before, but it is EY Financial Planning Services. They have been one of our strategic partners for over 16 years. We love working with them, and we hear great things with people working with them as well. What can they help you with? Well, all of these confidential professional advisors can actually help you via the phone unlimited hours regarding any financial planning questions you may have. Now, these types of this service is actually available to you at no additional cost. The costs for these services are actually included in Wespath's operating expenses, so they're paid by the funds. So technically, we can't say that they're free, but they are kind of free. So we encourage you to take them up on it. If you already have a financial planner, great. Now you have two. So they're there to give you objective advice and guidance. You know, which COLA should maybe I choose, or what benefits should I take or not take now? They're there to help with that. Again, you don't need to enroll in it. You already have it. You can call them up, and hopefully, this is all not new to you, but hopefully you've been receiving information from them already. This is a great slide to take a picture of. It has all of our resources available on it. You've got our Participant Solutions team, Benefits Access, of course, EY Financial Planning. But as Frank had mentioned earlier, we do have that specific retirement team that's available to you for the retiring class of this year. So they're there. They're wonderful people to be able to help with any questions you may have. And we're so excited about that team that we want to show them to you. So here they are. There's your team, your Wespath retirement team. Look at all those smiling faces. They are eager to help you with any questions as they help you through this change of status in the new chapter in your life. You also have the Wespath virtual one-on-one consultations available to you. You can speak with one of our benefit educators, Frank and myself, as well as Todd, who's in the laptop picture there, who's monitoring the questions. And then we also have the manager, Bob Christoffel. Go ahead and we'll have this link available in the recording that we send out along with the slides. So you can always just click on that link and schedule the date and time that works best for you. And you can, again, do this as often as you like, and it is a free service to you as well. Now, it wouldn't be a Wespath webinar without action planning slide. So we've talked about this before, but please go out and register for Benefits Access if you haven't already. And once you do, go ahead, play with it. You're not going to break it. You can just go through and just see how the different benefits will be when you actually decide to make those benefits and choose them in retirement, if you choose to do that. Again, review your beneficiary designation. Again, as I mentioned before, secondary beneficiaries, maybe your children, they tend to move around. They go from job to job, and maybe they're moving states, cities, addresses. Make sure that information is updated accordingly. Again, you can go out and review your life stage investment management profile. Again, maybe change if you want to from aggressive down to conservative or stay moderate, whatever is best for you. Go ahead and project your retirement income. Go ahead and run that retirement projection and see how much you might be expecting in retirement. Now, again, this isn't going to be the actual amount you receive, but it's going to be a great forecast to let you know approximately how much that amount will be. Register for EY Navigate, and actually call EY Financial Planning Services to help you through any questions, guidance that you may want. And again, contact us for the benefit education consultations. From this, we want you to know that you have a number of resources available to you. As Frank mentioned, a plethora of resources here for you. You are not alone in this. We've helped many retirees in the past, and we're here to help you through your new chapter in life. So on behalf of Frank O'Brien and myself, I'd like to thank you so much for joining us today. Again, any questions, let us know. But otherwise, congratulations to you, and have a great day.
Congratulations.